Right. This is a unexpected live stream, and I want to talk about what just happened this morning. And I was not planning on creating a live stream at all whatsoever. But this is a very alarming report that we got today, and I want to make sure that the sound is okay. And I'm so let's take a look at this real quick. And what happened this morning was the unemployment data just came out from 4.1% to 4.3%. And as you can see, I'm wearing a t-shirt today, and this is not something that I was really expecting to go live for. But the unemployment data came in this morning. It triggered what's called a Sahm Rule, spells SAHM if you don't know what that is. But it is a recession indicator that basically tracks the shifts in the U.S. employment rate, and they have been right about 9 times out of 10, and that's could potentially lead us into a recession. And what's alarming about this is that the government just sent out a notice saying that, well, the unemployment rate was because of the hurricane. Okay. Uh, you know, okay. Well, I'll let you, be the judge of that in the comment section, but it's just one of those things where I'm like, okay, this is has to be concerning. And I want to play you one of the clips that I had from when I went live stream about 2 live streams ago when I talked about the unemployment is something that they have to pay attention to. And this is absolutely alarming today that for me to go on a unscheduled live stream. And I kind of want you to get a little bit of insight on what's happening. And this is from 2 Federal Reserve meetings ago. That's what they're talking about. All the reporters, they were asking questions is that, hey, if we keep the rates where it is now, right, 5.25, 5.5%, and inflation comes down to, let's say, 2.3, 2.2, but what if unemployment rate shoots up to 4.5 or 4.6, and any weaknesses in the labor market? Jerome Powell pretty much said that, we're just paying attention to the PC inflation. We are paying attention to the labor market, but we're not going to make any changes if unless we see a sudden change in the labor data, right? So if we see something outrageous like 4% to 4.5%, that is a significant increase. You got to realize it's tens of thousands of people, hundreds of thousands of people when you think about the percentage wise when it comes to unemployment. So if it goes from 4% to 4.5, like we saw during the global recession in 2008, 2009, then that should trigger the Fed and say, whoa, hold on, are we doing too much where maybe we need to cut the rates by 25 or 50 basis points. They're not going to cut the rates by 200 basis points or 300. Yeah. So I talked about this 2 live streams ago, and I was saying that they're not focusing too much on the labor data. And I'm betting that they're all focusing on that right now. And the Sahm Rule was triggered this morning because the unemployment rate rising unexpectedly, and they missed the data by a lot. And I want to show you just kind of what I'm talking about here. And this isn't something that I really expected to do. But basically, in the past this many years, let me zoom in on it. So today, the unemployment rate from 4.1 to 4.3%, it fit the rule, right? And the last time that happened was in 2020, April 2020, when unemployment rate went to 14.8%, and it accurately predicted a recession. And the one before that was in 2008 when the unemployment rate came in at 4.9%, and that led to a global recession. And the one before that was in 2001 during the dot-com bubble, and in 1990. So the only one they didn't get right was in 1957. So as you can see, that a lot of people are just kind of selling off in the market right now. And right now, this S&P 500 is selling off heavily, down 2% right now. NASDAQ is at 2.5%, and Dow is losing about 750 points, almost 2% there. So this is something that I didn't think this is going to go from 4.1 to 4.3% in a matter of just 1 month. And now that the government is blaming it on the hurricane from a month before, and I'm like, that doesn't really make any sense. And this is something that I have been saying it over and over again, that we need to pay attention to what's going on in the labor market. Inflation is one thing. Inflation will come down eventually. But once we have that unemployment go way up from 4.5, let's say 4.5%, worst case scenario, let's say 5% at the end of this year, that's going to be getting worse in 2025 if that's the case, right? And I know you guys tuning in, just click on my thumbnail. It may seem like it's a fear mongering video, but it is something that you have to pay attention to, because we might be seeing a very weakening economy going into 2025. And for the jobs report that came out, and let me read this, okay? So US economy added fewer jobs than expected in July, while the unemployment rate unexpectedly rose to its highest level in nearly 3 years, so since October 2021. And the jobs were added by 114,000 instead of 175,000, and that really shocked the market. And and let's be honest, Wall Street is not exactly connected to Main Street, and they're kind of just reacting slowly. And us on the Main Street, we're noticing all these cracks, and we've been saying it. But I personally, I think the Fed is reacting very slowly to what's going on in the labor market. And by the way, this is going to be a short live stream and just kind of show you guys what's going on. And unemployment going into 4.3%. And just remember that just 0.1% or 0.2%, that is a significant increase. That is tens of thousands of jobs. And I just don't think the government using the hurricane as an excuse is a valid one. But just kind of going into the rate cut, just predicting the rate cut here. If you look at the CME watch tool, this is fascinating, because ever since this morning that labor report came out, they're pricing in 67% chance that the Federal Reserve will cut their interest rates by 50 basis points. Yesterday, it was 25 basis points. So there's a 100% chance that they're going to cut rates on September 18th. Now they're considering 50, or the market is pricing in more on the 50 basis points. Shouldn't the stock market be celebrating? Not necessarily, because the unemployment from based on the Sahm Rule, could be leading into a recession. We might very well be in a recession right now in Q3. We got the Q2 data that was about 24%, 2.4%. And we haven't seen the second estimate. We haven't seen the final estimate, and those are coming out soon, right? And we are going into a lot of uncertainty right now. And this is probably the most uncertainty I have seen since 2020, when our entire economy shut down. So something to really consider right now is that the rate cuts by 50 basis points might become a reality come September 18th. And we're going to get another unemployment data. Let me look at the dates real quick. That should be coming out. Let's see. It was August something. Let me get the dates right. Okay, unemployment is going to come out on September 6th. So that's going to be the next one before the Federal Reserve meeting on September 18th. And consumer confidence is already at low, right? So right now it's sitting at 60, and then PC inflation, the next one is going to come out on August 30th. And CPI, which I'm going to be going live for next Wednesday, or this coming Wednesday on August 14th, is going to be pretty significant, because the Fed could end up saying that, you know what, we all need to get together right now and figure out this unemployment data is coming in a lot weaker. And by September 6th, if unemployment rate increases from 4.3% to, let's say, 4.5%, the Fed needs to cut rates by 50 basis points. I think that's going to be 100% priced in by then, if the unemployment rate comes in a lot weaker. Okay. So if you look at the unemployment rate, just to give you a better picture here, as you can see, this was from 2008, 2009. And I want to set a reminder here, by the end of 2007, okay, can you see that? It was around I don't know why it keeps moving, but it was at 5%. We are only in July right now. So if we go into December and finishes the year at 5%, this is only going to go up in 2025. How much that's going to go up? We'll see what happens with the overall market, right? And I'm talking about the labor market, not the stock market. Now, 2008, 2009, at the height, it went to about 10%. Millennials, you guys remember that from 2008, 2009, global recession, right? Now, how long did it take us to go back down to the 3% level? That was about 9 years. It took us 9 years to get below 4%. So I would be very cautious. And I'm not telling you you need to sell everything like what everybody else is doing. And you can see me wearing a t-shirt today and just being a very informal live stream. I want you to be very cautious going into Q3, Q4, or for the remainder of 2024 and as well as 2025. I want you to pay attention to the unemployment data, because if that becomes higher, chances are we're not just seeing an inflation, we're going to see a deflation. We're going to see more layoffs. So if you don't have enough cash reserve and you're in that job sector that's more for discretionary sector, you need to make sure that you pile up your cash, have enough in your emergency fund so that you can cover for unemployment. And if you're in a job sector that you keep hearing that they're going to go through rounds of layoffs, you need to start looking for another job. And, if you have been following me for a while, uh, I've been partnering with Course Careers, and just check out their website. They have several courses where you can go to, maybe if you want to switch to another job sector. That's completely up to you. But now is the time to start buckling down, because this labor report, when I woke up this morning and reading this, I'm like, holy cow, this is not good. Okay. Not good. And are we going to see what it was like in 2008, 2009? Not necessarily. Are we going to see what happened in 2020? Unlikely, but we could see a very, very weakening labor market now that we saw Intel cutting their laying off what was it, 2,000 jobs from yesterday's earnings report, right? Microsoft's earnings and the forecast came in really weak. Apple did okay. Meta did pretty good, and Google came in a little bit weak, but not too bad. So the S&P 500 right now is being carried by the top 10 holdings, and the rest of the stocks are really weak right now. So I would like to see how it goes going into 2025. If the stock prices keep going down, let's say the index funds like keep going down, I'm gonna keep riding the wave. I'm gonna continue to buy, probably buy more if I want to. But if you're still kind of just starting out your investing journey and you don't have enough set aside in cash to pay for a potential unemployment, this is something that I want you to pay attention to. Okay. If you Maybe this is a good time for you to start cutting your expenses. If you think your job, your confidence in your employment is not going to be as high going into 2025, start cutting some expenses and start piling up your cash reserve. You should always do that. But if you have been ignoring what's going on in the labor market or what's going on in the economic condition, this is a time for you to get serious. And I'm showing you all these charts, and I can only make some predictions, but there's a lot of data, a lot of reports indicating that we are seeing a lot of cracks in our economy. So, and we're also in the election year, so we'll see what happens with the CME. With the rate cuts come September, we still got about a month and a half to go until September 18th. But them pricing in 100% rate cut at least by 25 basis points with a 32% chance. But now that the probability of cutting 50 basis points by September is even higher. So if unemployment keeps going up, let's say 4.7%, let's say to 5%, and by the end of this year, don't be surprised if the Federal Reserve starts cutting rates every single time they meet. So we have another meeting November 7th, 2 days after 2 days after Election Day on November 7th, and then we have another one in December. So they could be cutting rates every single time by 25 basis points. Easy money is coming in 2025, but for people who are much more established, right, and they have their cash reserve ready to go to deploy to the stock market, maybe they're buying more assets at a cheaper price, then you're in a better position. But if you're not in that position right now, and you need to rely on your 9 to 5 job, or you don't have enough cash reserve, starting today until the end of the year or moving forward until next year, just keep saving your money and trim your expenses. this is the time to do it. And for the labor market, there's something else that I want to show you guys real quick before I get off the live stream. It's been about 15 minutes. This is where all the jobs went, and I usually go over this during the CPI live stream, and I'm going to be live again on Wednesday to go over this. But healthcare and social assistance, that sector has been growing a lot. But if you take a look at manufacturing, it has been weakening for a long time, and this is pretty alarming going into like information, financial activities, loss of jobs, right? And professional and business services. Those are the sectors that have been weakening for a while. And you can go to the website to just kind of take a look at the employment situation for government. And the way I've been looking at government jobs, it looks like the public sector jobs are going to be a little bit safer than the private sector jobs, just based on the data that I've been seeing throughout 2024. So if you lose your job in the private sector, it might not be a bad idea to start looking into the public sector jobs. Maybe you want to become a federal government employee, or maybe you want to become a state employee or a local employee. They do come with a pretty good pension plan, and jobs are not safe anywhere, but they are slightly safer than the private sector, from my experience anyway. So, but anyway, so yeah, 114,000 jobs. That's for the month of June. The estimate was 185,000, and the unemployment rate climbed to 4.3%. And healthcare, yep. And let's see. No, that's about it. So, fear and greed index right now, we're sitting at the fear index right now, and people are definitely being more fearful than ever before. So could we see extreme fear going into August? We could. September is like one of the worst months for the stock market, so don't be surprised if we see some sell-offs going into August and September. And I posted this in the private community. So just if you're interested in joining my private community, just go to firesightchat.com/community and check out what the insights that I offer. But this is definitely something that worth paying attention to, worth going on live stream for a completely unscheduled live stream. So, but yeah, take a look at this. If you don't know what the Sahm Rule is, take a look at it, what it does. Maybe I can make a video about it in the future, but they have been, the rule itself has been very accurate about predicting a recession going forward. And today was one of the indicators that could put us into a recession. So I don't want to put too much fear into it, but I think it is something that you guys should pay attention to. Before I get off live stream, I do want to see what's going on with the Bloomberg here. Oops. Let's see, Bloomberg. All right.
China risk and the US-China tensions.
Kunjan, biggest customers of Intel include Dell. 19% of Intel's revenue comes from Dell, according to Bloomberg analysis. Lenovo, HP, Alphabet's up there as well. What do you think customers are thinking about buying from Intel in the future after seeing a report like this?
I mean, I would not think anything should change.
All right, yeah, they're just talking about Intel right now, but let me show you what's going on in the stock market real quick. This has been a pretty good sell-off. Right now S&P 500 is already down over 2%, and it looks like NASDAQ is already pretty close to the correction territory at down. Let me see. I'm gonna have to do some math here. But yeah, it's pretty close to the correction territory, and Dow Jones is down about 700, almost 800 points. So, yeah, this is a bad report. I think the Fed they made a mistake by not cutting interest rates yesterday at least by 25 basis points. All of this unemployment data is all considered lagging data. So, we could be in a recession going into Q3 and Q4. or maybe Q4 into Q1 of 2025, right? So let me know what you think in the comment section, and appreciate you tuning in with my regular t-shirt on and on schedule live stream. But I will be live again on Wednesday, and we'll talk about the CPI when it comes out at 5:30 a.m. or 8:30 a.m. Eastern Standard Time. And until then, see ya.